Enbridge posting profit in its latest quarter that topped expectations, profit driven by the mainline system, the vast network that moves oil south of the border from Canadian producers, but also its gas distribution unit. The company is a major owner of gas utilities in Canada and the United States. The company sticking with its 2025 forecast and saying US tariffs not expected to hurt its operations. Let's get more from MacNeil, Director of Equity Research at TD Cowen. Aaron, thanks very much for joining us. And you do have an amazing stat here for us. You say a premium valuation is warranted, given that 98% of EBITDA is cost of service contracted. And it's pretty predictable right through the end of the decade, this company's profit.
Yeah, I think, and Andrew, thanks for having me on. I think, one of the key investment features of Enbridge is the stability of its business. And if you just think about the broader macro environment today, that's pretty compelling. Enbridge is just a company that is on its front foot today and can focus on delivering growth between now and the end of the decade and not having to worry about, the day-to-day challenges that arise.
Does it have a big capital spending program in place right now?
Yeah, $28 billion is secured. They're looking at $8 to $9 billion per year. They can spend up to 9 to 10. They have capacity to do more or do tuck-in M&A. But it's essentially fully committed in the near term. They're working on opportunities to fill it in the long term. They recently had an investor day where they outlined 50 billion, 50, of potential capital projects in the pipeline that they're currently working on, with several that may reach a final investment decision in the next 6 to 18 months. So again, there's just a lot of opportunity in the system, and Enbridge is well positioned to take advantage.
What are they spending on? New oil pipelines, for example?
Yeah, not new greenfield oil pipelines today, but you brought up oil. They announced an open season today on Flanagan South. That's part of their main line in the U.S. They're going to hopefully, to the extent that they have customer interest, increase capacity by 100,000 barrels per day. They add that with 50,000 that's currently idle, and that paves a path to do a full expansion of the main line from Hardisty in Alberta all the way down to the Gulf Coast of 150,000 barrels a day, which they're talking about, at least on the conference call, potentially reaching an FID by the end of the year. But, if I were to really look at where they're spending money, it's all on the natural gas side. There's significant drivers there, be it data centers, be it LNG export capacity growth, coal to gas switching, et cetera. And so if you really drill down into where they're spending money and where they expect to sanction new projects in the future, it's largely on the natural gas side.
Their yield, something like 5.9% right now. Just remind us, have they been steadily increasing that dividend?
Yeah, the growth rate has slowed in recent years. The payout ratio is admittedly high, but among large cap S&P TSX dividend aristocrats, they would have among one of the highest yields. I haven't looked recently, but it would be a top 3 yield among that cohort. And so, it'd be very difficult for other large cap Canadian companies to catch up with them.
We'd better jump. Thank you very much indeed for joining us, Aaron.
You bet. Thanks for having me on.
MacNeil, Director of Equity Research at TD Cowen.